Welcome back, everyone, to the Automotive Market Minute, in which may or may not take just over a minute. My name is Stephen Georgella.
My name is Philip Tributowski.
And I'm James Sivko.
All right, guys. So first of all, welcome to August, and one heck of an interesting start to the month. But we are going to be covering what the hell happened in the month of July. We're going to talk about our aggregate dealership performance from across the country. We'll talk about some of the recessionary signals, and I know that if you were around for the start of August, you're definitely feeling those. So we'll talk about those and rate cuts, consumer sentiment and buying intentions, inventory and sales, interest rates, and some interesting stuff along the way. You won't want to miss it. Let's get right into it. So when we're looking at aggregate performance, July versus June, of course, first and foremost, we've omitted a little bit of the information from the CDK dealers, E-lead dealers. So let's keep that as an asterisk. And of course, hopefully, God willing, when we do August numbers, we'll finally be back to normal. Shout out CDK. Anywho, traffic up 11% month over month, leads just about flat, appointments up 3.17%. You'll see a little bit of a slouch there with new sales. Normally, we're not seeing that too much July versus June. Normally, it's the opposite. And then used sales up 7.05% month over month. Okay, so July versus 2024 versus 2023, you'll see a lot more traffic. Lead volume was up 1%. Appointments, we got those salespeople grinding. We're like, no, we're not going to be order takers anymore. We are going to make sure that we are grinding the leads and setting appointments. And boy, did they ever. New sales up 2.73%. It's interesting to think about how many more new vehicles are on the market, yet only 2.73% up year over year from our data set here. And then used sales, even though they were strong last year, they're even stronger this year. So with that said, I have a couple of brainiacs. I'm going to let them loose. Go ahead, gentlemen.
All right. In April, we showed that there was bullish momentum. The dollar was falling alongside with the price of oil. 2 months ago in our June market minute, we started to show that there were some recessionary signals that, again, were starting to show. Jobs were declining rapidly. Consumer loan defaults were increasing. And existing home surveys, which we followed up in June and July, we showed that we're down to 2008 levels. The realtors are not busy. And we have a kind of a pet theory here that these buyers may be delaying home sales, and this might be a small tailwind to auto sales. But starting out August, we got some new job data. The unemployment rate rose to 4.3%, and that triggered the SOM rule. Right now, it's appearing as if it's only a consumer recession. Industrial is still going bananas. The construction sector is going crazy. There's been a lot of reshoring back to America. We're using a lot of manufacturing capacity. And again, right now, it looks like this is a consumer-led recession in the event that we get one. Previously, whenever the SOM rule has been triggered, it has resulted in a recession. That being said, I was doing some deeper research and I looked at the SOM rule by state level. Right now, only 18 out of the 50 states have actually triggered the SOM rule, at least as of this most recent month. And so we're kind of on the edge, but nonetheless, recessionary signals have started to show. And with that, the odds of a Fed rate cut are now starting to become much more priced in, if you will. We've been talking about the market pricing in interest rates and rate cuts. And again, it looks like people are calling for the next Fed meeting in September for there to be a rate cut. Potentially, with the market sell-off that we saw in early August, people were calling for an emergency rate cut. So as far as what's ahead, we could be looking at something along these lines. James, Stephen, anything to add here?
Yes, right now the market's pricing in 4 rate cuts between when we're recording the market minute and the end of the year. But keep in mind, this is an interest rate market that priced in 6 rate cuts for the year, and we're already in August and the number's been 0. So we will see, but maybe some relief will come in terms of interest rates.
And so, James, in the event that the Fed cuts rates, what might that mean for auto sales?
So this is a graph that we showed you last month in the market minute. This is auto sales volumes over a long period of time going back to the 70s. And we've inverted Fed funds here alongside it. And you can see that there is a supportive relationship between lower interest rates and auto volumes. So hopefully, if we do get some rate cuts here in the fourth quarter, that stronger auto sales will follow.
And now, question for you, James, would that be immediate, or may we see kind of a small delay in that? Because if I look here, as the Fed cut rates here, it looks like auto sales kind of dropped around 2008 and similarly here.
Yeah, as you know, rate cuts sometimes or interest rate movements take about 12 months to kind of feed their way into the economy. So this might set us up for a decent 2025 if the Fed moves aggressively.
Jumping into consumer sentiment, here you can see a chart of consumer sentiment since dating back to the start of 2022. Main thing I wanted to focus here is, despite this sell-off that we saw in the stock market to start the week after this weaker unemployment data came in, consumer sentiment is still up 1.2% year to date. It's remained relatively unchanged in August. But we have an additional slide here. So James, take it away.
This is an excellent slide. The Conference Board has been surveying consumers since the 1970s about their car buying intentions. This slide is the answer to the survey question, are you considering buying a car in the next 6 months? And the graph on the right is a stacked bar chart of new, used, and either. And so the fun part about the business is, at any time between 9 and 12.5% of consumers, or really 9 and 15% of consumers, are actually considering buying a car in the next 6 months. July's number, the survey in July, which came out last week, was a little weak. It's in about the 18th percentile of responses since the 70s in terms of answering yes in some capacity to buying a car in the next 6 months. You can see this is a noisy series. So the graph on the right, what we did is we put it in a histogram for you so you can see where July is just alongside kind of all responses. Our graph here goes back to 2010. The Conference Board changed the way they conduct the survey in 2010, but we've got a good 13 years of data here for you. Keep in mind, it's a noisy series, so weak answers in 1 month might be strong answers in the next, but so far, the next 6 months in terms of consumer intentions are looking a little weak.
Looking at national inventory levels, this slide is starting to get interesting. New inventory is up to a new post-pandemic high of 3 million units. That is up 53% against last year. New days supply is roughly 45 days, roughly 80% higher than the same time last year. And the used day supply is up 14% versus 2019. Inventory's up, and it's up big. Steve, you had a couple dealer examples that you wanted to share, didn't you?
Yeah, I got a little information from my sources inside the clubhouse, if you will, here. So from one of my sources, one of them, one of the largest Ford dealers in the state of Texas, and one of them, one of the bigger Ford dealers in the state of Michigan, got some information about the inventory offerings that were brought to them just at the first week of August. And they were massive. And nearly all of the inventory offerings that were given to both of them were turned down. We're talking all the vehicles that they were dying for only a year, 2 years, 3 years ago, all the Super Duties, F-250s, et cetera, turn them down, turn them down, turn them down. And they pretty much turned down all of the allocation that they got. And even where dealers down south geographically, they needed these types of vehicles. Up north, they needed different types of vehicles. All dealers even looking at those dealer trades that they needed to do a couple of years ago. There's such a surplus of inventory that there's not a concern whatsoever. And from what I heard from one of the Ford dealers was that when they listed the type of inventory that had extra allocation, there wasn't, according to my source, according to sources, there was not a single model left off the list, according to sources.
Now, let's look at national vehicle sales. Now, since the CDK outage, that did impact the industry over the last couple of months. We have started to see new retail sales start to rebound, but we're still not getting back to that prior trend and what is really normal for this time of the year. Against the same week in 2023, sales were actually down 15% lower. And again, there remains more ground to cover for us to get back to normal. And we have a beautiful graph to show the relationship between inventory to sales. So James, take it away.
Yeah, the password here is channel stuffing. We expect inventory levels to rise as the manufacturers try to stuff inventory onto lots. This is a long-term chart of the inventory to sales ratio, and it just kind of outlines really the COVID effect of there not being any inventory on lots. And we have now returned to approaching a normal level, which is, over the last 20 or 30 years, been about 2 times inventory to sales. I would check the trailers when they come in to make sure the manufacturers didn't sneak an extra car on there this year.
Yeah, what's been interesting to see is the not only the allocation of which vehicles are actually giving the stores, but then also the way the manufacturers are talking, whether it's in quarterly meetings, whether it's things that you see on the news versus what we hear from the dealerships. There's no parity. It really makes very little sense. And I've been fortunate enough to be inside some rather strong dealerships the last couple of weeks, and just hearing the narrative, we're sitting in this position where it seems, Phil, going to your point, factories have pulled back on all these incentives, and the consumer, the word I used yesterday is stretched out or stretched thin, right? And then when we go to last month, going back to pre-pandemic versus when we got an injection of money into the market, into the economy, and then now where we're at now, you said something earlier in the call, which I think was really important. You talked about the fact that this could be a consumer recession versus where manufacturing, et cetera, is at. My hypothesis there is this. Based on what I saw during COVID, the money rose up very quickly. People that made money made a ton of money, and middle and lower income didn't really do any better whatsoever. That was my observation based on all of our experience and the information that I've read. Now, you have these businesses and these business people that made a lot of money. And even if they did well in savings and all of that, they're spending a lot of money. And again, James, I'll probably want your feedback here. They're spending all this money building infrastructure, thinking that almost in this like perma bull mentality. It's like, we got to keep building. We got to keep the momentum going, right? Well, if the consumer has a recession, it pulls down all of this. So I'm just wondering, it's like, okay, so of course these guys would have to go first. The consumer would have to feel the pain first. Again, this is my observation. The consumer would feel the pain first. It would then pull down. And what I would think is if I overinvested, if I overbuilt, such as, institutions and talking about manufacturing, if I overbuilt and overspent and overinvested, well, now I get pulled down much faster than the consumer. The consumer starts to pull me down. And then all of a sudden out of nowhere, once they stop spending money because they've been stretched too thin, boom, the bottom drops out. James, is there any merit whatsoever to what I've said here?
Yes, prior recessions have been in a low inflationary environment. We may actually have growth in the economy, and we just won't have real growth. So our growth rate will be something lower than inflation, but it's possible to have a recession where numbers keep going up. And usually when you have a recession like that, it's the consumer that takes it on the chin. So if we do drop into a recession here this year, it will probably be a consumer-led and a consumer-focused one.
So with that, with where rates are at, and we'll cover that in here in just a second, new vehicle financing transactions at 0% or featuring a 0% APR are down to 2.6% to start August. It's a year-to-date low. And less than 3% APRs fell to an 8-month low in July, and they're actually further down in August. So despite these inventories continuing to build up, we're actually seeing less and less incentive support from these factories. And then moving into where average auto loan rates are at right now, even with this deteriorating labor market that has started to increase the odds of the Fed finally acting, finally starting to cut rates. But with that news, I know mortgage rates have started to trend lower. Average auto loan rates really haven't moved much, and they really won't until the Fed actually takes action.
Yeah, so we've been a little defensive here about what we think the next 6 to 12 months might look like in the business. But this is a great slide because we've shown you volumes before in terms of auto sales, but this is dollars. And this chart goes all the way back to 1992. And it's just a great illustration of the long-term franchise value of staying in the phone book. There's a great saying in the oil business, hey, we're just trying to stay in the phone book. If we can survive some cycles, the long-term franchise will be there. What this chart shows us is that since 1992-ish, the price level has tripled. If you're able to stay in the phone book, the long-term franchise value will be there. because there are so many long-term tailwinds to being in the business. There's some population growth tailwinds in this number. There's some inflation tailwinds in this number as well. And auto dealers are a very important part. They're 19% of retail sales in the country. And so there's just a great franchise value if you're able to get the ship through the rough seas.
And going to what we were at a Ford dealer yesterday, as I mentioned here in the beautiful state of Michigan. He had said to me, he said, Stephen, I can already feel the shift. And we were here in 2008. We knew what to do. We knew we needed to shift courses. And when everybody pulled back, we put the throttle down. And we're seeing that with our strongest dealers right now. There is, of course, there's mental apprehension. Any of us would feel it, but they're seeing the fact that as long as they follow the consumer, they will be around and will be in a much better position after any possible recession does hit. So the last thing I wanted to say here is it was important for me to hear him talk about the shifts that they made historically, and then basically the fact that they're hearing that parity is really no longer there. He's hearing that, okay, I'm hearing that dealers out east from a Stellantis standpoint, he told me that dealers are selling out east, Chrysler dealers, Stellantis dealers are selling without blue sky. The fact that a dealership now all of a sudden like that would sell with no blue sky. So I'm interested to hear the feedback from dealers, hear the feedback from people about the fact that over here, this Ford dealer is losing $80,000 a month where it was making $100,000 a month. And then all of a sudden you have stores like the one we were just at in Michigan yesterday, who's climbing and set a year-over-year record. And it just seems like what we're seeing is what was here is becoming here. It's getting farther and farther. And I just haven't seen that in my time in the automotive space. And so with it really shifting away, what happens is we're starting to organize our information in the future, trying to figure out, okay, regionally, what the hell is going on and why are those certain markets hurting more than other ones? Obviously, we have a chief economist here, James, who will be able to give us plenty of insight going forward. So fantastic. On behalf of my wonderful colleagues, James Sivko and Phil Trebetowski, my name is Stephen Georgella. We will see you next month on the Automotive Market Minute. See you.